Tony and mymortgageguytony.com. Let's talk today about rates, real estate, and recession. Are we heading into a recession? What does that do to rates? And what does that do to real estate? I think one of the biggest questions I get right now is, should we wait? We're watching rates go up. We're watching home prices go up. There's got to be a bubble. It feels a whole lot like 2005, 6, 7. And so we're going to maybe wait on the sideline until prices come down. So instead of listening to a lot of the misinformation that we hear in the media, let's take a look at the numbers. So I'll minimize my screen here. So I put together a little presentation just to talk a little bit about rates, real estate, recession. I'm going to make this as quick as possible. So let's take a historical perspective on how the Fed intervenes in a market environment like we're in right now, which is rising inflation. We're in the highest inflation we've seen in 41 years. Now, mortgage rates track with inflation, which is why we've seen this rapid rise in mortgage rates. Now, if we go back to the late 70s, early 80s, inflation was rising from 7 to 14%. Mortgage rates went from 12 to 18%. They've got to rise with inflation. And the Fed funds rate, Volcker came in and he raised the Fed funds rate over a 2-year period from 11 to 20%, which had a dramatic impact on inflation, brought it from 14 down to 5%. Mortgage rates went from 18% to 12%. Now, the kind of other consequence of these movements is it wreaks havoc on the stock market, which likes to see growth. And so we went into a recession. Now, a recession, basically by definition, is 2 consecutive quarters of negative GDP growth. And so you can imagine that when things slow down, that's where we see this recession. So then in the 90s, Greenspan was in an inflationary environment that went from 1.75 to 3.5, pretty moderate by today's standards, what we're facing right now. Mortgage rates went from 7 to 8.5%, again, rising with inflation. He took the Fed funds rate from 4.75 to 6.5. The inflation response went from 3.5 down to 1%. Mortgage rates went from 8.5 to 5.5%, again, coming down. Recession. So then Jerome Powell is now in this inflationary environment, went from 1.5% to 8.5% very rapidly. Mortgage rates went from 2.5% to, frankly, closer to 6%. The Fed funds rate was at 0, and it's been at 0 for a long time. Now, it's going to raise to 3%, perhaps more. They raised just a week or so ago 0.75. They're talking about raising again in the next meeting in July. So what should we expect from this historical perspective is inflation should drop. In fact, based upon what we're looking at with a 12-month rolling average, we should start to see inflation mitigate by October. And if that does in fact happen, then mortgage rates will, as history repeats, should decline as inflation declines. Now, are we heading into a recession? Some could argue, based on today's GDP release, that we're in that kind of negative growth area and leading into a recession. Now, there's other things related to the unemployment as well as the inverted yield curve that I could go much deeper into, and happy to if anyone wants to dork out with me on some of this stuff. But those are some other leading indicators that do point toward kind of a recessionary environment. So what does that do to mortgage rates? Well, mortgage rates in recessions come down. So if we look again back in the late 70s, early 80s, mortgage rates went from 16 to 11.75. Each of these gray bars are recessionary periods. In 1982, it went from 18 to 13. In the 90s, 91, it went from 11 to 8.75. In 2002, it went from 7.375 to 6.75. Every single one of these recessionary periods, 6% to 4.875. And then we got into 2020, went from 3.75 to 2.75. So again, as we look historically at how the Fed intervenes and what happens as a result, if we're leading into this recession, which economists are forecasting, we will see mortgage rates come down. Now, what does that do to house values? We might expect that house values would decline. but that's not the case. So in every single recessionary period, home values increased with the exception of one. But this was the real estate crisis, the mortgage meltdown, a number of different things that contributed to these challenges that we did see a reduction in property values. However, there were a lot of other indicators or other factors that contributed to this. One was extremely low birth rates leading into this market, which was essentially the median age of first-time homebuyers, which make up the bulk of new household formations, people moving out of their parents' home, was at an all-time low preceding this recessionary period. Plus, we had the fog and mirror loans, where a number of people should not have gotten mortgages and then defaulted on those mortgages. Plus, we had an absolute surplus in supply and not the demand based upon the demographics. So then we get into the 2020 recession, and again, property values went high. So when we take a look at inventory, and if we go back to that 07 period, we were at a peak in housing inventory at 3.7 million. You fast forward to a little bit before today, and we had 870,000. I think this is about 1 million right now. And I'm going to put out another video that quantifies that million as to how many are actually available, and we'll go into much more detail there. But look at this massive difference in the inventory that we're dealing with right now versus what we were dealing with in this crash in 07. And then we look at household formations, or the number of households. Hopefully I didn't cover all these things up. But in 07, there was a demand for households of 116 million versus today, or 2021, of 130 million. So there's 14 million more households and 3 million fewer homes. So this is the most basic tenet of economics, which is supply and demand. When there's not enough supply and too much demand, prices will rise. And so we're going to be in a rising home price environment, which is why it's important to understand that rates will cycle. We're expecting to see rates come down as early as end of the year into first quarter of next year. But unless you have a time machine, these house prices are going to continue to go up. Now, will they go up 20%? No. But just because they're going to moderate off of the very high appreciation we've seen over the last 30 months doesn't mean that they're going to go backwards. So buying a home is going to get more and more expensive from a price standpoint. Mortgage rates will come down. We can always refinance you into a better, longer term solution to make things easier. But the key really is getting into the market as soon as you can. If you have any questions, happy to go through this in greater detail. You can reach out to me, and I look forward to chatting. Thanks so much.